You are about to discover how to get business financing with bad personal credit. You might see it advertised all the time. Get approved today, even if you have bad credit. But this statement alone breeds skepticism. It sounds too good to be true. It even sounds like a scam. Banks require good credit to get approved, as you know. And most people only go to their bank when they need money. But the most common business bank loan, SBA loans, only account for 1.1% of all business loans per the Department of Revenue in 2013. The reality is the big banks are not the suppliers of most business loans. And even though they require good credit to qualify, many sources don't. It's not a scam, it's common sense. Businesses can succeed even if the owner doesn't have perfect credit. And many business loans make really good sense even if the owner doesn't have good credit. So what types of funding can and can't you get with bad credit? Loans you can't get with bad credit include SBA loans, conventional bank financing, private investor money, and most unsecured financing. SBA and other bank conventional loans are tough to qualify for because the lender and SBA will evaluate all aspects of the business and the business owner for approval. To get approved, all aspects of the business and business owner's personal finances must be near perfect to ever get approved. There is no question that SBA loans are tough to qualify for. This is why, according to the Small Business Lending Index, over 89% of business applications are denied by the big banks. Private investors want average or better credit of 650 scores or higher in most cases. They will also want solid financials for at least 2 years. Think of private money as being for SBA and conventional bank loans that just miss the mark. Unsecured financing means no collateral is required for approval. Supplying no collateral greatly increases a lender's risk. No collateral requirements usually means it's the quality of credit that determines qualification. You can qualify with a credit partner in many cases, but that credit partner would have to have good personal credit. There are many types of financing you can get approved for with bad credit. Some of these include revenue-based financing, collateral-based financing, equity financing, crowdfunding, business credit, and unsecured financing using a credit partner or personal guarantor. There is a lot of capital out there that business owners can obtain, and most of it isn't available through big banks. This massive amount of available financing is available to you based on your business strengths. So as long as you have a strength to offset your weakness of having bad credit, you can be approved. This is often called compensating factors. Many businesses have already proven concept and have consistently increasing sales. Their strength is that they have shown stability and that they can effectively run a growing business. The risk to the lender is less as they are established businesses that are growing. As you commonly hear asked on the popular show Shark Tank, how are your sales? Sales are the difference between an untested concept or idea and a real operating business. Will your idea be well received? Do you know how to operate a business? Sales answer these questions. For revenue-based financing to qualify, you must ask, does the business have existing cash flow proven by bank statements, not tax returns? Does the business have over $60K annually received in credit card sales? Does the business have over $150K annually going through their bank account? For merchant advances, you must be in business 6 months for merchant advances and 1 year for revenue lending. No startup businesses can qualify. High approval rates meaning most who apply get approved. You must have 10 monthly deposits or more. Most advertising you see for bad credit business financing are these products, such as the advertisements you can see here. Here are some more ads relating to cash flow financing. See how much state that startups are not accepted and that the business must have $10,000 in sales or more? With revenue-based lending and merchant advances, these are short-term advances of 6 to 18 months. Mostly short-term at first, then when half is paid down, lender will lend more money at a longer term. Merchant advance loan amounts are available up to $1 million. Loan amounts equal to 8 to 12% of annual revenue per bank statements. For example, a company that has $300,000 in sales might get $30,000 advance initially. 500 credit scores accepted and are common with merchant advances. Bad credit is okay as long as you aren't actively in trouble. To get approved, you can't be in a bankruptcy. It's tougher to get approved with recent tax liens or judgments. Rates range from 10% to 45% depending on risk with revenue-based lending and merchant advances. Risk factors include industry, time in business, bank statement details, number of deposits, average daily balance, NSF charges, amount of deposits monthly, credit. Usually rates are higher on first advance until you prove yourself to the lender. No tax returns are required for approval with merchant advances and revenue lending. No other income docs are required. No collateral is required. In some cases, no PG is required. Good credit is not required. Collateral-based financing, you can get money based on the strength of your collateral. Since your collateral offsets the lender's risk, you can be approved with bad credit and still get really good terms. Common business collateral might include account receivables, inventory, equipment. With account receivable financing, you can get up to 80% of outstanding receivables advanced to you within 24 hours. 1 year in business required to qualify. Must be receivables from another business. Rates range from 1.25% to 5%. Inventory financing is another powerful collateral-based financing program. Minimum inventory loan amount is $150,000. General loan-to-value is 50%, thus inventory value would have to be $300,000 plus to qualify. No lumped-together inventory like office equipment. Rates are normally 2% monthly on the outstanding loan balance. Example of companies who can qualify for inventory financing is a factory or a retail store. With equipment financing, the lender will undervalue equipment by possibly up to 50%. Major equipment only. Lender won't combine a bunch of small equipment. First and last month's payments required. Loans up to $2 million. There are even some forms of personal collateral that you can use for business financing, including 401ks and IRAs. And you can use stocks as collateral for financing. 401k or IRAs can be used for a type of financing known as 401k financing. You can be approved for financing up to 100% of the value of the 401k or IRA. Rates are usually less than 3%. Steps for setting up this type of financing include: a new corporation is formed. A retirement plan is created, allowing for investment into the corporation. Funds are rolled over into the new plan. The new plan purchases stock in corporation and holds it. Corporation is debt-free and cash-rich. Stocks and other securities can also be used as collateral for business financing. You can borrow as much as 90% of the value of those stocks. Rates as low as 1.6%. You can be approved for a working capital line of credit. Challenged personal credit is accepted with this type of financing. Here you can check out some online ads relating to 401k financing. So if you see these in the future, you know now the exact program that's being referred to. With equity financing, you exchange a percentage of ownership in your business for financing. This type of financing is much like you see on the popular TV show Shark Tank. Credit is not an issue typically with equity investors. Equity investors are looking for a tested and proven concept, not just an idea. Having sales will really help your chances of being approved with an equity investor. Crowdfunding is a very popular way to get money nowadays. There are lots of sites or platforms available today for crowdfunding. This type of funding gathers money from a crowd or a lot of people instead of one big investor. If the crowd likes your idea, they may donate money to your project. Much of crowdfunding doesn't need to be paid back. Many of your crowdfunding investors will be people you know, while others might see your project and be interested enough to invest. Business credit is an outstanding way to get money for your company. Even if you have other financing, you still should always have business credit built. Business credit is a great way to get money because approval is not based on personal credit. You basically start getting approved for a few vendor accounts who will initially offer you credit. Once those accounts are reported to the business credit reporting agencies, those initial accounts create trade lines, and a credit profile and score are established. The company's new profile and score can then be used for you to get credit for your company. Newly obtained credit is based on the company's credit per the EIN, not the owner's credit based on the Social Security number. Personal credit doesn't matter as the credit linked to the EIN is used for approval, and when done properly, personal credit isn't even looked at for approval. Vendor accounts are initially applied for and take 1 to 3 months to report. Once reported, the owner can start to get approved for store credit cards. Once 10 trade lines are present on the business credit report and one account has a $10,000 high limit, then Visa-type accounts can be acquired. It takes about 6 months total time to get approved for Visa and MasterCard-type accounts. Store credit limits on business credit accounts might range from $300 to $10,000 plus. These accounts report to business credit reporting agencies, not consumer credit reporting agencies. Rates are commonly 0 to 25% APR with introductory rates of 0% for 6 to 18 months. Beyond business credit cards, there is another form of lending known as unsecured financing, where you use you or your partner's personal credit to get approved. This type of unsecured credit requires no collateral, but it does require good credit to get approved, as approval is based solely on personal credit to qualify, unlike with business credit accounts. You can use another partner or personal guarantor to qualify for this program. The applicant is then liable for the business debt as there is a personal guarantor, unlike with business credit. With unsecured financing, approval amounts from $10,000 to $150,000. Card limits are equal to what the signer has on their credit now, but you can commonly be approved for 5 cards, meaning you can get 5 times more credit than your highest revolving card limit now. There is no consumer credit reporting. Most of these accounts actually report to the business reporting agencies, helping you build your business credit along with getting your financing. Excellent personal credit with open revolving credit is required for this program. You must have 2 or less inquiries on your personal credit report in the last 6 months to get approved. Interest rates range from 0 to 25% APR, with 0% introductory rates being common for the first 6 to 18 months. The lending sources get you approved for multiple credit cards from multiple sources. Multiple cards means more competition between the card issuers. Lenders commonly raise limits over time due to this competition. The lending source even shows you how to get near-instant limit increases. Lending sources help you secure 5 times what you could do on your own. Contact us today to learn more about how to get business financing with bad personal credit.